If you graduated high school knowing how to find the circumference of a triangle, but nobody taught you how credit cards work, why inflation destroys your savings, how taxes actually work, or why most people stay broke their entire lives, then congratulations. You went through the same education system as everybody else because somehow we learned about mitochondria, but not how a car payment can financially ruin you before 25. And the crazy part? Most adults still don't understand money either. So in this video, I'm going to explain everything about money you probably should have learned in school without the boring finance bro nonsense. The first thing you need to understand is this. Saving money alone will not make you rich. And honestly, that's one of the biggest lies people are taught growing up. Because your parents probably told you, save your money. Your teachers told you, put your money in the bank. Sounds smart, right? Except inflation exists. Every single year, your money quietly loses value. So if inflation is 3%, but your savings account gives you 0.01% interest, you're basically paying the bank to hold your money while it slowly dies. That's why your grandparents bought houses for like $3 and a grilled cheese sandwich. Meanwhile now, a studio apartment costs the GDP of a small country. And this is why rich people don't just save money. They buy assets. Assets are things that can grow in value. Stocks businesses, real estate investments. Poor people work for money. Rich people own things that make money. That's one of the biggest mindset shifts nobody teaches you. Credit cards are probably the most misunderstood thing in finance. People either think credit cards are scams or they treat them like free money. Both are dangerous. Here's how they actually work. Credit cards are tools. That's it. If you spend money you already have and pay the card off every month, credit cards can actually benefit you. Cash back, travel points, building credit, fraud protection. But the second you start carrying balances, that's when things get ugly. Because some cards charge over 25% interest. 25%. Loan sharks from medieval times are probably watching like, damn bro, calm down. And this is where people get trapped. You buy food, clothes, random Amazon stuff at 2 a.m. Then suddenly your minimum payment barely touches the debt. That's how people end up paying double for things they already bought. The system isn't designed to help impulsive people. It profits from them. Your credit score is basically an adult report card, except instead of your GPA deciding your future, it's this weird invisible number. And yes, it affects almost everything. Apartments, car loans, mortgages, insurance rates, sometimes even jobs, and nobody explains how it works. The easiest explanation? Your score tells banks, can this person be trusted with debt? That's it. And ironically, to build good credit, you actually need to use credit, which makes no sense at first. It's like needing job experience to get your first job. The easiest way to build credit responsibly, use a credit card for small purchases, keep utilization low, pay it off in full every month. Simple. Not easy for everybody, but simple. This is probably the most important part of the entire video, because most people do not stay broke because they're stupid. And most people don't stay broke because they're lazy either. They stay broke because they accidentally get trapped in systems that slowly drain them financially for years. And the scary part is, most of the time, it doesn't even feel dangerous while it's happening. Usually it starts with lifestyle inflation. And lifestyle inflation sounds like some complicated economics term, but really it just means the more money you make, the more your spending expands to eat all of it. You get a raise at work, suddenly your entire life upgrades itself automatically. Now, the old car feels embarrassing. The old phone suddenly feels too slow. You start ordering food way more often. You convince yourself you deserve expensive subscriptions you barely use. And somehow, without even realizing it, your expenses rise at almost the exact same speed as your income. So even though you technically make more money, your financial stress barely changes. That's why somebody making $45,000 a year can feel broke. But somehow, somebody making $150,000 can also feel broke. Because income alone doesn't create wealth. Margin creates wealth. The gap between what you earn and what you keep. And social media makes this problem way worse. Because now people constantly compare their real life to somebody else's highlight reel. You see luxury apartments, luxury vacations, designer clothes, perfect aesthetics, fancy dinners. And after seeing that stuff every day, normal life starts feeling behind. So people start spending money emotionally instead of intentionally, not because they actually need something, but because they want the feeling attached to it. Status, validation, success, recognition. A lot of people are not buying products. They're buying identity. That's why somebody will finance a luxury car they can barely afford, just to impress people they don't even like. And the craziest part? Most actually wealthy people do the exact opposite. There are millionaires walking around in plain hoodies driving older Toyotas that nobody notices. Meanwhile, somebody else is making $70,000 a year leasing a car that costs more than their annual rent. Because real wealth usually looks boring. Debt looks flashy. That's an important distinction. And honestly, the more financially intelligent someone becomes, the less they usually care about looking rich. Because once you understand money, you realize freedom matters more than appearance. A person with no debt, money invested, emergency savings, and low stress is financially in a way better position than somebody making double the income with massive payments hanging over them every month. But society rarely celebrates financial peace. It celebrates visible consumption, and that pressure traps people for decades, because once your lifestyle expands, it becomes emotionally painful to downgrade it. That's why people stay stuck in jobs they hate, not because they physically can't leave, but because their bills became too big, their lifestyle became too expensive, their freedom disappeared. And that's really what financial mistakes cost you, not just money, options. And by the way, if this video is actually helping you understand money in a way school never did, drop a like and subscribe. Seriously, I'm trying to make finance content that actually feels useful without screaming at you about a wealth mastermind from inside a rented Lamborghini. One of the most damaging beliefs people have about money is this: I'll start investing once I make more. And on the surface, that sounds completely reasonable. Because people imagine investing is only for rich people. Like you need a suit, a financial advisor, a six-figure salary, or some secret Wall Street knowledge. But that's not really how wealth building works anymore. In reality, investing matters most when you start early. Not because you need huge amounts of money, but because time is ridiculously powerful. That's where compound interest comes in. And compound interest is basically financial magic. It's the closest thing money has to cloning itself. Because instead of only earning money on the money you invest, you start earning money on the growth too. And then that growth starts growing, which sounds small at first. But over long periods of time, it becomes insane. For example, someone investing small amounts consistently starting at 18 years old can actually end up wealthier than someone who starts investing much later with a way higher income. Why? Because time matters more than intensity. That's the part people underestimate. Wealth is usually not built through one giant lucky moment. It's built through consistency, patience, discipline, and very boring repetition, which is probably the least exciting answer possible. But it works. And honestly, the stock market is psychologically fascinating because it's one of the only places where people panic when things go on sale. If Nike shoes dropped 40%, people would sprint into stores. If TVs dropped 40%, people would call it the best deal ever. But when stocks drop 40%, people suddenly think civilization is collapsing, even though long-term investors usually benefit from buying quality assets cheaper. Now, obviously, investing always has risk. Nothing is guaranteed. But historically, time in the market has usually mattered more than trying to perfectly time the market. And that's another mistake people make. They wait forever trying to find the perfect moment to start. Perfect economy, perfect timing, perfect amount of money. Meanwhile, years pass, and the biggest advantage they could have had, time, disappears. Because the earlier you learn financial habits, the more powerful they become later. Small decisions repeated for years become massive outcomes. That works positively and negatively. Want to know one of the fastest ways to stay financially stuck for years? An expensive car payment. And look, I understand why this happens. Cars are emotional. People associate cars with success, status, confidence, attractiveness, freedom. Dealerships understand this extremely well. That's why modern car sales are rarely focused on total price anymore. They focus on monthly payment, because monthly payments psychologically feel smaller. Somebody hears $72,000 car and gets nervous. But if you say only $740 a month, suddenly it sounds manageable. That's the trick. Stretch the loan long enough, and almost anything can sound affordable. But affordable monthly and affordable overall are very different things. And a lot of young people accidentally lock themselves into years of financial pressure trying to look successful early. Meanwhile, that same monthly money invested consistently over time could genuinely change their future. Because cars usually depreciate, assets ideally appreciate. One drains wealth, one builds it. And again, this doesn't mean never enjoy your money. That's not the point. The point is understanding opportunity cost. Every financial decision has a hidden future version attached to it. That $800 monthly payment isn't just $800. It's future investments, future flexibility, future freedom. People often only calculate what something costs today. Financially smart people calculate what it costs them tomorrow too. At the end of the day, money is not really about being flashy. It's about freedom. Freedom to leave jobs you hate. Freedom to survive emergencies without panic. Freedom to help your family when they need you. Freedom to take time off. Freedom to breathe. Because constant financial stress affects everything: your sleep, your mental health, your relationships, your confidence, your future decisions. And unfortunately, a lot of people spend years trapped in survival mode financially. That's why financial education matters so much. Not because everybody needs to become some billionaire entrepreneur, waking up at 4 a.m., taking ice baths while answering emails on a treadmill, but because understanding money changes your entire life trajectory. It gives you options. And options are powerful, because when you're financially desperate, you're forced into decisions. But when you're financially stable, you can choose. That's the real goal. Not looking rich, not flexing online, not pretending to be successful. Real wealth is invisible most of the time. It's peace, it's stability, it's flexibility, it's waking up without fear. And if you learn this stuff early, you give yourself a massive advantage most people never get. So if you made it this far, comment the biggest thing school never taught you about money. And subscribe if you want more finance content that actually makes sense. I'll see you in the next one.